What you need to understand here is when you purchase an investment property, you have now created a tax-deductible debt, okay? That tax-deductible debt is essentially it's beneficial to you, yeah?
Sure. Life changes. That's why I tell people don't buy your retirement house in wherever in Queensland in 20 years' time. You don't know what you'll be doing in 20 years' time. The goal is to reverse engineer where you need to be, where you need to get to, put yourself in that position. And at that time, at that point in your life, you're free to make the decision that you want to make at that point in your life.
I always say to my clients, making money is a lot easier than saving money, right?
100%.
Way easier. If you were to have just purchased investment properties in 2022, 2023, 2024, and you leveraged and you purchased in the correct areas, right? Each of those properties would have probably increased about $200,000 each. Yep. So let's just say you purchased 3. Then it's increased 200, 200, 200. You got 600K.
Yep.
Could you have saved $600,000 in 3 years?
I'm very excited as today we have the #1 ranked single mortgage broker business in Mortgage Choice for the nation, a multi-business owner and now co-developer with over $200 million in upcoming projects in the pipeline, Dan Liao. Welcome, Dan.
Thank you. It's good to be here. Yeah, man. It's really good. Yeah, it's been a while, man.
In the pipeline for a while.
We have.
Yeah,
have you been well?
But I've been really well. I'm excited. I want to talk about paying your home loan off in 10 years. Now, there's a lot of people out there that currently have a mortgage in Sydney, in Melbourne, wherever they are, could be Brisbane, and they've got a 30-year term, right? They've got a 30-year mortgage term, and they want to pay it off sooner. They don't want to be a slave to the banks, to the monetary system, and they want to pay that debt off. Now, let's get into how they can best navigate the system to achieve the outcome of that early payout figure. Removing the shackles, getting rid of the debt, and owning their home outright without the bank involved.
Sure, absolutely, man. Look, it's an interesting one, right? Because they actually have to go against the grain of understanding that to be able to clear their home loan at an accelerated rate, you actually have to buy an investment property. Yeah. So the trick with that is to simplify it as easily explained as possible is you need to actually acquire an investment property and you need to utilize a strategy called debt recycling. Yeah. Now, the way that it actually works is the goal is to clear your owner-occupied home loan. So reduce your non-tax deductible debt as quickly as possible. While when you purchase your investment property, you essentially just float your tax-deductible debt, okay? So to make it really simple, right, most of the time you'll have a mum and dad, right? They've purchased their owner-occupied home loan. They've purchased their owner-occupied home 5, 6, 10 years ago, yeah?
That might be in Sydney. Let's say $1.5 million home, $2 million home.
Yeah. Well, whatever number that is, right? It's not too important on that aspect, right? The main thing is that they've purchased an owner-occupied home and they haven't accessed their first investment property yet, right? Right then and there, they have this non-tax deductible debt essentially is just sitting there. And what they're doing is, because interest rates are a little bit higher at the moment, they're paying their mortgage and they're probably just paying the minimum repayments, just getting by, right? Because cost of living, so on and so forth, yeah? What you need to understand here is when you purchase an investment property, you have now created a tax-deductible debt, okay? That tax-deductible debt is essentially it's beneficial to you, yeah? Now, the whole goal of debt recycling as a strategy is you want to essentially increase or at least float your tax-deductible debt while accelerating the reduction of your non-tax deductible debt, right, which is your owner-occupied home loan. Because we all know an owner-occupied home loan and an investment home loan is not equal, yeah? Investment properties are paid for, the loan is paid for majority by someone else as opposed to an owner-occupied home loan where you are the only ones paying for it.
Well, that's why they say the investment property is an investment and your owner-occupied property is not an investment.
Well, yeah, that's right.
Yeah.
Robert Kiyosaki always says, right, it's your biggest liability.
Yeah.
Yeah. And yeah, look, I agree with that. Now, the way the debt recycling actually works is you would draw out equity, right? So you take out a loan against your owner-occupied property, yeah?
So you'll have some equity in there. So you'll have a portion of it, and it might have gone up over the last 5 years, for example, right?
Oh, for sure. It's definitely gone up over the last 5 years.
So it's gone up, and then you have some debt left, whatever that may be, and then we want to extract that little bit of equity we can up to 80% LVR.
You don't even need to extract up to 80%. It really depends on the actual client itself, right?
Yeah.
So using this as an example, let's just say someone has $500,000 owing on their own occupied home loan, okay? And in Sydney, their property's probably worth $2 million, right? What you would do is you would draw out 20% of the next purchase price, so your investment property, plus an additional amount. Whatever that amount is, your broker should be able to tell you, yeah? Now, when you do draw this out, you have it as a separate loan for investment purposes, yeah?
Yep.
You set that loan on interest only. You purchase your investment property, say it's a $625,000 purchase, and then you take out another $500,000 loan, right, which is secured by your investment property, yeah? So right there, let's just pause for a second. What does that actually look like for the client at that time? Well, you have a $500,000 mortgage, yeah? You have your equity extraction loan, then you have another $500,000 mortgage secured onto your investment property, yeah? You'd have the two loans, the equity extraction and the investment property loan set on interest only, okay? Now, the reason why you actually take out more than what you need for the investment property purchase is because the equity extracted is then used to pay for your investment property loan and for the equity extraction, right? So you have surplus cash that pays for the investment property and then pays for your equity extraction. Then you go, well, where does the rental income go? Well, what you do is you actually redirect cash flow into your owner-occupied home loan. Yeah. So what you do is, let's just say, as an example, you have $600 per week gross coming from your investment property. That's $600 a week. You then take out management fees and other fees included, for running investment properties. But when the rental income comes in, you pay it directly into your own occupied home loan. Okay. Now,
because that's not the tax deductible debt.
Correct, right?
Yes.
And then because you have your equity extracted, so remember, this is a really important thing people have to understand. What makes a loan tax deductible is not the security it is attached onto, it is the purpose in which the funds are used for. So if it's used for investment property or investment purposes, it is now a tax deductible debt.
And that's how we get tax deductible debt from our home loan.
Correct. Yeah. If you want to say it that way, for sure. Yeah. I'm
just trying to make everyone think at home. So this is a term that most people now watching at home will hear referred to online as debt recycling.
Correct. Yeah. Because what you're doing is you are recycling your debt, right? So all you're doing is you are converting, you are transferring the debt onto tax deductibility debt as opposed to non-tax deductible, right? So you want to think of it like this. The surplus funds are now used to pay for your investment property loan, right?
Yep.
Investment property, investment purposes, tax deductible.
Yes.
But when you redirect the cash flow for $600 per week, let's say you minus off the fees, let's just say it's still about $2,300 in actual net income that you receive per month, right? You get that net income, you pay it into your mortgage, right? So if you have a $500,000 mortgage, right, per month, your minimum repayments on a 5.89% interest rate is most likely going to sit around that $2,300 to $2,400. You've now essentially doubled your repayments because you've redirected your investment property income into your actual owner-occupied home loan. And what you'll find is the debt will, the actual debt itself, it'll actually reduce at an accelerated rate, and you'll find that most likely you'll pay off your home loan in about 10 years. Yeah. And people think, okay, well, how does that actually work? Why is my owner-occupied home loan. It costs $2,300 a month to pay. But then all of a sudden I redirect another $2,300 into it. How does it go from a 30-year term down to a 10-year term? Well, you have to understand, home loans are top-end heavy. All the interest is charged at the top, right? So by accelerating it, it compounds itself into an accelerated rate going downwards, yeah? So it's not equal, right? So the more you pay it down, the faster it goes down. The less interest charge means the more principal coming off, which then means and equates to a home loan paid off in probably about 10 years and 2 months, right?
Yeah. So it's speeding it up at such 3x essentially.
Yeah, it's a third of your home loan. Like, man, I have run these scenarios through multiple clients, right? And it is the one thing that if you are not doing, you need to start. You really need to start, right?
So the majority of Australians we're not taught this in school. We don't know this, and what's interesting is I actually know there's quite a fair few mortgage brokers that don't know this themselves. They don't put this into practice themselves, so they obviously can't teach it. So it's not something that's quite common out there, but it is necessary to put yourself in a really good financial position with the way in which everything is going and the cost of living constantly rising.
For sure. You know, the one thing to see, this is the thing, right? Most people don't get is that to accelerate the reduction, you actually have to take out more debt, right? But the debt isn't equal. The debt is tax deductible. The debt is for investment purposes, right? So what do you do after you get to the end of the 10 years? Well, if you wish, you can accelerate the reduction of your investment property loan now, right? It depends. Like, everyone has different objectives, different goals. Some people want 10 investment properties, 20, 30, 40, whatever it is. Or some people actually just want one owner-occupied home loan paid off and then one investment property, right? So to truly understand how to actually get ahead, you actually need to leverage your cash and actually take out an investment property.
So you need to not fear debt. Good debt is tax-deductible debt.
Correct.
And good debt will get you out of the bad debt, which is your principal place of residence, which is the non-tax-deductible debt that you have on your own home.
Correct. Yeah. I'm not saying like take out as much debt as possible. Don't go out and lease a Lamborghini or something, right? That's not the debt that you want.
There's people watching this right now that are thinking of that. I guarantee you.
Yeah. Look, it's a funny thing. Yeah. Look, I'd love to be able to just go and get one. Yeah. I probably actually. Look, we won't touch on that.
It's another topic. That's the next podcast.
Yeah.
But yeah. So basically, utilizing that strategy of debt recycling to downpay your principal place of residence can be done in such a simple way with one or two investment properties, which will absolutely change the trajectory of that home loan and change their lives forever. But then you've also got a category where if you are super comfortable with the debt and you actually want a lot more wealth and you want to go and let's say, I want to retire on passive income of $200,000, in 10 years' time or whatever it may be, that can be done as well.
Yeah, definitely.
So it just depends on your outcome.
Yeah,
your goals.
For sure. It really depends on where that actual person is in life, right? So not everyone wants to, I think everyone wants to retire early, but not everyone has the appetite for risk of actually going out to getting it. Yeah. So I think the main thing that most people require is someone to speak to that can provide them with clarity so that they can understand how to move with confidence, right? And that's exactly what we do every day in my brokerage, right? We literally sit down with the client and I just show them facts, I show them logic, I show them numbers. This is how it will look, right? We can project to a certain point, right? There's always a lot of people out there saying, oh, you can do it up to X amount of years and we can project and buy X amount of properties. Yeah, there is. There's a potential for that, right? But I think the main thing that I actually focus on is how do I provide accurate advice up to about 2 to 3 years, right? Yeah. Because everything changes, man. Like a married couple might have another child, right? This, that, everything kind of just happens. And we all know during COVID, right?
Yeah.
1 year wasn't even predictable. How do you predict 2, 3, 4, 5, 10,
100%.
right?
Yeah.
So all of this is like, can you pay off your mortgage in 10 years? Here's the facts. Here's what it looks like. The answer is yes. However, it could pay off sooner, right? Depending on if your income increases over a period of time, you can start putting extra principal payments in. Or it might not finish as soon as 10 years because you have had another child. You may want to holiday more. You want to go, your missus wants to go Europe in summer,
Yeah.
So it really depends on the client.
Life changes, and I think that's the best part about this is you're reverse engineering everything at your brokerage to get people to see how it can be done and to literally put them in that position, right? But also, I think with how life changes, and they say 50% of marriages end up in divorce, you could move house. COVID was unpredictable. You might want to, get rid of your job and go live abroad go live in Europe for a year or whatever.
Sure.
Life changes. That's why I tell people don't buy your retirement house in wherever in Queensland in 20 years' time. You don't know what you'll be doing in 20 years' time. The goal is to reverse engineer where you need to be, where you need to get to, put yourself in that position. And at that time, at that point in your life, you're free to make the decision that you want to make at that point in your life. And from wherever you are, whatever job you're in, whatever partner you're with, whatever state you live in, you can, you're in a financial position to be able to make that decision, right? And do what you want.
Yeah. Look, I speak to a lot of people, right? And very rarely will there be a forever home. Like that's something.
Even if they plan it.
Even if they plan it. But you have to remember, right, these days is completely different from, my parents' generation, right, where most people back then, they did buy a forever home. They would move somewhere, buy somewhere, and then they would just pretty much stay there.
Our parents grew up on a village. I'm pretty sure your parents grew up in a village.
They grew
pretty much. Yeah,
pretty much. Yeah.
So
No.
It's one. They have that village that they're fond of, that they grew up in their whole lives, and then they buy that one house. It's very common.
For Asians, it's Sunnybank.
Sunnybank's the place.
Yeah.
We're going there after this.
Yeah. Are we?
I don't know. We'll go.
But look, I think what I'm really trying to get to here is this day and age, there's more people that actually want to move around because lifestyle has become a much more focused factor than just having one place, right?
Yeah.
Like I see it all the time. I would help someone get from their forever home that I helped them get, and then they say, hey, you know what? I actually want to move to the Gold Coast now. I want to live near the water. I want to live near the ocean. I want a completely different lifestyle, right? Because COVID ruined me. Like I had to stay at home. I couldn't do these things. Now I really actually find this as something that I really like. I prioritize. I want a better lifestyle.
Yeah, and we've seen that shift from people wanting the train line to get into the city, right? And more so now, beach cafe lifestyle, because it's not 30 years ago where you had to catch a train and you had to go to the city and, now it's everyone working on Zoom, everyone wanting that change the lifestyle post-COVID. It's the priorities have shifted for
sure
for Australians.
Yeah. I think like one thing I can definitely say is if you really do want your forever home, the longer you can delay purchasing the forever home, the better that forever home is actually going to be.
Yes.
If you focus on purchasing investment properties, right? Because remember, an investment property loan or an investment property is not equal to an owner-occupied home or an owner-occupied home loan.
Yes.
Yeah. The key factor is to understand your investment loan is paid by someone else. Majority of it is covered by someone else, right? Because if you think of it in this terminology, I always say to my clients, it's like, if you have $1 million owner-occupied home loan, you're paying for it, right? You're going to feel it.
Yep.
You're not doing Europe in summer, right?
Yeah.
You're definitely not doing Europe in summer, brother. Yeah?
Yes.
But if you have $1 million in debt and it's investment and it's covered majority by someone else, you're going Europe in summer. And you're also got multiple investment properties growing every single year.
Yes.
And if you're intelligent about it and you have an accountant that you can speak to, you can then manufacture, negative gearing, right? So negative gearing, once again, like talking about this is it shouldn't actually be your end goal. Like it should not be the objective, right? Because I have a lot of high income earners that go, I want negative gearing. Yeah, for sure. Negative gearing, great. Like take advantage of it, right? But I always say your focus should be actually to try and have an investment property which is positively geared, and then you manufacture a negatively geared environment, right? So what does that actually mean, and how do you get there? Well, let's break it down. Negative gearing is a terminology used to say that your investment property, the revenue coming in and the expenses are higher than the actual income that's coming in, right? So
you're covering the shortfall.
Correct. So you're losing money from the investment property at that time. You're not really actually losing money, right? Your cash flow is less, right? However, the asset's growing in value anyway. So if no matter how you cut the cake, you're still ahead. Yeah, you get a tax benefit, right? But this is where things get really interesting, right? Once you have the investment property for quite a while and you have it in a positively geared environment, right? So it is making money, it is covering itself completely, right? And you're a high income earner. Well, what can you do to create negative gearing? You renovate the property. You increase its value through renovation. Then because you've increased the value through renovation, say you've put in some air conditioners, you've done this, you've done that. Now you have an opportunity to increase the revenue as well. So what do you get out of that? Well, firstly, number one, you get a property, which is yours, right? Positively geared, paying for itself through the year. You plan with your accountant, you do your renovations. You then now create an expense, 10, 15, 20K. That then reduces the revenue, obviously, right? It creates the expense. And now you have a shortfall, which then now means you are negatively geared. Yeah?
Yep.
So you negatively gear on purpose, but then what you've done as a byproduct of that is you've increased the value of your home, your asset. You've received a tax deduction. And then on top of that, you now have the ability and the reason of why you're going to increase your rent.
Extract.
1, 2, 3, right? There is so many benefits when it comes to purchasing an investment property that most people don't even look at because it's debt. Oh my gosh, it's debt. I don't want to take out anymore.
We're taught that.
Yeah. Buy your home, pay it out in cash, this and that.
It's funny how many people will worry about taking out good debt, but will actually take out bad debt in the form of zip pay or credit cards. Like, are you seeing a lot of that?
Yeah, for sure.
Yeah.
Well, look,
it's all about perception.
Well, the reason behind that is because it's much more easily obtainable. It's the same thing as like someone won't try to buy an investment property, right? Because they don't know whether they can be approved because there's a fear of hearing the answer no.
Yep.
So what they do is they go out and they buy a car, right? They leverage a $150,000 vehicle, $200,000 vehicle. Now they have $2,000 a month in home car loan repayments, as opposed to like purchasing an investment property, which will probably have $2,000 a month in expenses. In minimum commitments as well. The only difference is the investment property is going to keep flying upwards.
Yep.
The car is going to keep going down.
Yeah.
Unless you get like a GT3 or something, then you're good. You're good.
We're always going to circle back to that. But limited edition cars. But yeah, so I think in summary, I think a lot of Australians need to really take a look at debt recycling and utilising the equity in their principal place of residence to obviously create wealth through, because the investment property goes up in value. Your principal place in residence goes up in value. The difference is we're going to pay our principal place of residence off sooner by utilising the funds correctly and saving that or cutting the loan time by 3x, right? Yeah. So
it's an absolute game changer, man. If you are someone out there right now and you have only one property and you want to clear that loan sooner, you need to buy an investment property. You need to buy an investment property for the sake of your retirement, but also for the sake of just clearing that owner-occupied home loan, right? Because once again, what you just highlighted, right? If you purchase an investment property and you have your owner-occupied home loan, you have two assets that are growing with supply and demand and inflation, yeah?
Yes.
So if you have two of them and every year goes on, your wealth compounds, yeah? And if the more that you have, 3, 4, 5, 6, whatever, wealth doesn't, you don't increase your wealth by 1, 2, 3, 4, 5, right? It literally doubles, triples, quadruples. The more that you actually access, the more investment properties you access, or the more assets you access that go up with supply and demand and inflation, is the key to you retiring comfortably.
Yes.
Because
debt is devalued.
Yeah, man. Like,
debt is devalued.
It is. If you take out $500,000 from the bank and you purchase an asset, that asset's going to keep going up. That $500,000 isn't really $500,000 anymore. It's worth even less, right? Because we all know money being prints a lot faster. It's printing a lot more than 2 to 3%.
Yeah, and everyone's not realizing that $200,000 worth of debt back in the 90s was a lot of money. $200,000 worth of debt today for a house, not a lot of money.
Man, if you can get $200,000 of debt for an owner-occupied home loan right now, you're winning at life.
You're winning, right?
You're winning.
So what is it? Has the $200,000 changed or what's gone on? Well, it's simple. The $200,000 doesn't have as much buying power, as much value.
It's less value.
So you know, it's just simply been devalued over time through the printing of money, the debasement of currency.
Yeah.
Right.
Yeah.
And everyone's got to learn that the more assets you buy, the more good debt you take on, the more 1 property, 2 property, 3, 4, 5 you have, the more total portfolio value you have, the more they continually go up in value, but the debt still stays the same.
Yeah, yeah.
That's what everyone's missing.
Yeah, exactly.
You know, so that's how wealth's created, and that's what the wealthy know that the poor and middle class don't.
Yeah. Man, I think one really big thing to highlight, right, is if anyone was to do the maths, right? Say you right now you're a higher income earner. I don't know. Let's say above the average of let's just say you earn $200,000 and then your partner earns $100,000, right? You got a total household income of $300,000. Your lifestyle is going to reflect somewhere close to someone that earns with a household income of $300,000. Yeah. Do this exercise. Get the age in which you would like to retire, 60, 55, 50, whatever it is, and then just go a bit dark here and go, what age do I think I'm gonna, I'm gonna move on, right? Yep. And say you go 60 years old, and say you're gonna live till 90, you got 30 years, right? Do the exercise and get the income and increase. Do the exercise and figure out how much super you're gonna receive up until the day of retirement. Add that up together. Right? Now divide it over 30 years, right? Most people will find that they will have $25,000, $30,000 a year to spend if they're lucky. When averaged out. Yeah? So you're telling me you've gone from working 40 years, 50 years, or 60 years of your life, whatever it is, right? And now you've gone from an income and a lifestyle of $200,000, $300,000, and now you have to adjust all the way down to 20, 25, right?
Well, either adjust that or you need to adjust the time that your lights are out because you're really not going to survive.
Yeah. So just party hard when you retire.
Just party hard.
Just get rid of it.
Out because I'm broke. So it's
Yeah. And so, I promise you, man, when people actually do that exercise and get really real with themselves, they're going to actually see, like, man, I got to do something. I have to leverage. I have to purchase an investment property. I have to work hard when it's my choice to work hard. I have to take the risk when it's my choice to take the risk because if not, I will be put in the position where, unfortunately, I just have to work. I have to do this. The problem isn't you want the option, right? No one likes being told that they must do this just to get by. Like that's the worst feeling. Like you're stuck. You created your own prison. You created your own environment. So while you can, work more. Do what you need to do. Take the high risk because I can tell you.
And the sooner, like you said, the sooner you do that, the earlier you can do that for anyone in their 20s, 30s, the sooner you can do that and take on the good debt and buy those investment properties without taking on the principal place of residence, the further and better you will be, or the position you'll be in later.
100%.
You know?
Yeah, definitely. It's very easy to understand, right? That you can't save yourself into wealth. You cannot save your money into a position where you are completely comfortable. We all know this, right? Like I always say to my clients, making money is a lot easier than saving money, right?
100%.
way easier. If you were to have just purchased investment properties in 2022, 2023, 2024, and you leveraged and you purchased in the correct areas, right? Each of those properties would have probably increased about $200,000 each.
Yep.
So let's just say you purchased 3. Then it's increased 200. You got $600K.
Yep.
Could you have saved $600,000 in 3 years?
No, you can't. And this is what I really want to break down to everyone at home right now that is currently out there working, whatever you're doing as a career. You either are there's 2 ways to make money. There's 2 ways to create wealth. I see it like this, right? You're an amazing entrepreneur. It could be 3 ways. One's inheritance, right? So for those of you who aren't inheriting shit, you're in the other 2 categories. Now you either become a really good entrepreneur. Okay, you're a business owner. You're a business owner. You're a really good entrepreneur. You're really, really good at what you do, and your business is successful, and you're running, an 8-figure business or whatever you're doing. Then you've got simply utilize, a good team to put you in a great position and set up a good property portfolio with the right structures. And we were going to discuss that in another podcast, right? The right trust structures and so on.
Yeah.
And buy the right properties with the right data sets and create that wealth through property. Because that's the way I see it for the majority of Australians. They're missing out because they're not successful entrepreneurs. They don't run successful businesses, but they're not utilizing their serviceability and creating wealth through real estate. While there's a small portion that are making great money, and getting themselves that financial freedom through real estate.
For sure, yeah. Look, my average client has between 4 to 6 properties, right?
Yeah,
and some of the other ones that have stayed with me a bit longer, up to 10, going on to 15 or so on and so forth, right?
Yeah.
And yeah, you are right. We can definitely discuss those structures a little bit later.
Let's get on to that one. Okay. But Mr. Dan, thank you so much for joining us, Dan Liao. Thank you so much for joining us. If you got a lot of information and a lot of value out of this, please share this with a friend. Like, subscribe. That's why we do this. We love doing this content so that you can, so that you enjoy it and show us that appreciation. We appreciate you for watching this episode of Property Banter by Pinnacle Buyers Agents. We'll see you next time.